Assalamualaikum warahmatullahi wabarakatuh. We are from Group 6 International ICT Business, Faculty of Economics and Business, Telkom University. My name is Najun Normaliza. We want to explain about monetary policy, and I will describe what's the meaning of monetary policy. Monetary policy is a policy issued by the central bank in the form of regulating the money supply to achieve certain objectives. Monetary policy can involve setting loan interest standard, margin requirements, capitalization for the bank, or even acting as a last resort or through negotiated agreements with other governments. Monetary policy is basically a policy that aims to achieve internal balance, or high economic growth, price stability, equitable development, and external balance, or balance of payment balance, and the achievement of macroeconomic goals, namely maintaining economic stabilization, which can be measured by employment opportunities, price stability, and a balanced international balance of payments. If stability and economic activity is disturbed, monetary policy can be used to restore or stabilization action. The effect of monetary policy will first be felt by the banking sector, which is then transferred to real sector. Monetary policy is an effort to achieve high level of economic growth in a sustainable manner while maintaining price stability. To achieve this goal, the central bank or monetary authority tries to regulate the balance between money supply and the supply of goods so that inflation can be controlled. Achieving full employment opportunities and smooth supply or distribution of goods. Monetary policy is implemented with one, but not limited to the following instrument, namely interest rates, statutory reserves, foreign exchange market intervention, and as a last resort for banks to borrow money when experiencing liquidity problems.
Hello, my name is Divina Permatasari, and now I will tell you about the goals of monetary policies in economy.
The goal of monetary policy is macroeconomic condition to be achieved. And the goals for every country is not the same, because every country have different of their own monetary policies. Monetary policy goals are also not static, but they are dynamic because they are always changed based on their own country economic needs.
Here, the several goals of monetary policies. In the first is to maintain of money values, because bank has authority to increase or even reduce the money circulation in the market. If bank spend more printing money or make a lot of money, there will impact to reduce the rate of exchange rates or make the exchange rates more cheaper than other country. That's why the central bank must be able to measure their action for economic stability. And in the second goal, that is inflation management, because these policies have the goals to management the inflation some country. Because the inflation too high or too low, that's not good enough for the economic country. That's why the country economic must be monitored by these policies. And the third goal is for solving the unemployment in their country, because for made these policies, the country have a big hopes to can reduce employment in their country and to make a lot of work opportunity and employment expansion.
Okay, from the three goals, what I said, it can conclude that The goals of monetary policies are to promote maximum employment, stable price, and moderate long-term interest rate. By implementing effective monetary policy, the Fed can maintain stable price, thereby supporting conditions for long-term economic growth and maximum employment.
Okay, I think that's all. 3 goals of these monetary policies. Thank you.
My name is Murti. I'm from class MB44 International 2. Today I'm going to explain how monetary policy can affect the businesses. So monetary policy is a policy that controls the interest rate. Monetary policy usually shows up when inflation happens. Inflation is an increase in the price of goods and services. When inflation happens, monetary policy increases the interest rate so that businesses and people will not borrow more from the banks, but they will save the money. When that happens, recession will happen in the economy because the productivity of a business will be decreased and the people's consumption, people will less buy the product from the business because their money is being saved in the bank. When that happens, recession will happen. But in a business cycle, after the recession, there will be a recovery in an economy. When the recovery happen, they will start from the beginning again. Business will increase their productivity again, and people will have more money from their saving to buy the product. Where, of course, the business will be success, and the GDP in the economy will increase. So I think monetary policy is very influencing to a business, because when interest rate is increased, the business will fall, but the price will be stabilized. But when the interest rate is decreased, people will borrow more, and the business can borrow more easily from the bank to increase their productivity.
Okay, hello, my name is Fauzan Afisa Faria Putra from Group 6, and now I will continue to explain about monetary policies, especially the impact of monetary policy to the Indonesian economic. So, basically, the main objective of monetary policy is to maintain the stability of the Indonesian currency value, which is the Indonesian currency value is rupiah. The stability of the currency value will reflected through the stable and low inflation rate in Indonesia, of course. So in order to make it happen, the Bank Indonesia, or commonly known as BI, as the heart of the economic flow in Indonesia, established a policy rates known as the BI 7DRR, which serve as the main instrument to influence the economic activity to achieve the desired inflation rate. Bank Indonesia also has the authority to set and implement the existing monetary policy, which are: the first one is to set the monetary targets by taking account to the predetermined inflation rate targets. And then the second one is to carry out the monetary control using various of ways. The ways in which this policy adjustment that affect the inflation are commonly known as the monetary policy transmission mechanism, in which this mechanism reflects the action taken by Bank Indonesia to adapt the monetary instrument and operational targets on various of economics and financial variables before ultimately affect the inflation as the ultimate goal. However, the transmission of the BI7DRR to achieve the inflation rate targets operates through a very complex channel, and also it is highly dependent on time lags. these BI7DRR mechanisms operates through interaction between various of things, including the central bank, banking system, the financial sectors, and also the real sectors. So, what makes the policy becomes crucial for the economic flow of Indonesia is because considering any changes of the policy will affect inflation through various of channels, including the interest rate channel, exchange rate channels, the credit channels, the asset price channels, as well as the expectation channels. For instance, any reduction in the BI7DRR policy will lower lending rates and thereby trigger demand for corporates and households. This lower bank loan interest rate will also reduce the cost of capitals for companies that want to invest. So in conclusion, the condition, the flow of the financial sectors, banking system, and the real sectors play a really important role in the effectiveness of the monetary policy transmission mechanism for the Indonesian economics or vice versa. So that's all from me about the impact of the monetary policies to the Indonesian economics, and after this my friend will continue to present the conclusion about the monetary policies presentation. So thank you.
Hello everyone, my name is Faraz Adilabai. So in this part of this video, I will basically summarizing this topic. So we have learned that monetary policy is the macroeconomic policy laid down by the central bank, and it involves management of money supplies and interest rates. So in conclusion, businesses at the macro level have policies that affect the continuity and success of a business, namely monetary policy. And the policies are regulated by the central bank by determining the amount of money circulations and increasing interest rates. And this will indirectly, of course, affect the market prices and even the economic stability, which will also more or less might have an impact on the conditions of your own business.